Okay, this video is going to talk about profit maximization, how a firm maximizes profit. And I have some numbers up here. I've just made up some numbers. So these are completely made up numbers, but they illustrate the situation that a firm might find itself in. Now, a couple of things I have to talk about beforehand. One is that this firm is going to be a price taker. We're going to talk about this in chapter 9. A price taker is a firm that has no impact on the market price. That whatever the price of, say, bananas happens to be set in the marketplace, they can sell bananas at that price, but they can't sell bananas for a higher price. They can't sell bananas for a lower price. So a price taker can sell as much as they want at the market price, but they can't try to charge a higher price because in perfect competition, as I talk about in the chapter, you have many sellers and they're producing a homogeneous product. A homogeneous product means that the products of the different firms are perfect substitutes in the eyes of the consumer. Since they're perfect substitutes, then consumers would simply choose to buy the one that's cheapest. They don't care about anything other than the price. If you've got a firm that's already selling, if you've got a bunch of firms that are selling bananas for $2 a pound, it's not going to be possible for another firm to come in and sell bananas for $3 a pound or $2.50 a pound or anything more than $2 a pound. They'll have to sell bananas for the market price. So this firm, in this case, in one of the numbers I made up, they're a price taker, and they're going to take a price of $20. And so looking at a few different quantities that the firm would have here. Let's suppose they could sell 18 units, 19, 20, 21, or 22. Profit is revenue minus cost. So let's write this out down here. And the revenue in each case is simply going to be $20 times the quantity. So the revenue is in these cases is simply 20 times 20, so a price of a revenue of $400. So the revenue here, and that's just 20 times the quantity. And I've made up some cost numbers. So here's the cost numbers that I've made up. And then in each case, all you'd have to do is take the revenue minus the cost, subtract that out, and you get profit. You got a bunch of profit numbers here. And the firm wants to maximize profit. We assume that firms are trying to maximize profit. Businesses are in business to make money, and profit is the money they make when a profit is a residual. So the firms are incurring these costs. This firm is incurring these costs hoping to sell the product, and they end up being able to sell it for $20 a unit, and then they get this revenue. But they've incurred costs, and then they sell the product for whatever the market price might happen to be, and the profit is whatever is left over. And so that's this difference here. It's the residual of it belongs to the owners of the firm. And since they're in the business to make money, they'll want to pick the quantity that's going to give them the largest profit. They want the largest dollar profit, not the largest profit per dollar. They want the largest dollar profit. And looking at the numbers here, well, 46 is the biggest, so we can circle that and say, okay, 46 is the biggest profit, and that'd be at a quantity of 20. But we want to think about, well, what turned out to be true so that we could add the largest profit here. And to do that, we want to look at marginal cost and marginal revenue. Marginal revenue is the change to revenue when you sell one more unit of the good. Marginal cost is the extra cost of producing one more unit of the good. So marginal revenue is just in each case, as we change the quantity here, the extra revenue you get from selling one extra unit. For a price-taking firm, the marginal revenue is exactly equal to the price. So in this case, price is equal to marginal revenue, but that's only going to be true when the firm is a price taker. Later in the class, we'll talk about some cases where firms aren't necessarily price takers. But for a price-taking firm, the marginal revenue is just the price. So the marginal revenue is constant at $20 here. Marginal cost is the increase in cost. Well, I had to tell you what the marginal cost was here because we don't have the cost for 17 units. But in each case, we've got the marginal cost calculated here. And we can see that the highest profit occurs at a quantity of 20. And why is the profit the largest there? Well, for quantity 18, 19, and 20, we can see that the marginal cost was less than the marginal revenue. That in terms, and that meant that profit has to be going up, because if you think about marginal revenue is how much your revenue goes up when you sell one more unit. Marginal cost is how much your cost goes up. If your cost goes up less than revenue goes up, then profit has to be going up. So you can figure out your profit from producing one more unit is simply the marginal revenue minus the marginal cost. So profit should be going up $3 here. Well, you can't see that because we have the previous one, but then it goes up $2 here, and then you can see, oh, it would go up $1 here. But then marginal cost gets to be greater than the marginal revenue. It's 22 versus 20, so profit is going to go down $2. It goes down from 46 to 44. And the marginal cost goes up to 25, and the profit goes down from 44 to 39. So what we've seen is that the crucial thing is you have to compare marginal revenue and marginal cost. When marginal cost is lower than the marginal revenue, the firm will make a larger profit by producing more output. When marginal cost is greater than marginal revenue, you would make a smaller profit if you produced output. So what will end up being the case is that the firm is going to want to expand output. They're going to want to expand output until marginal revenue is equal to marginal cost. When we make up numbers, we don't necessarily get it to be quite that even here, but once we just start drawing graphs, you'll see this very easily on the graph that you can find the point where the marginal revenue and marginal cost curves intersect, and that's going to be true to maximize profit. This rule, this profit maximization rule, marginal revenue equals marginal cost, is going to be true for any and all firms, whether they happen to be price takers or not. Later on in the chapter, we'll get to in chapter 10, where we talk about monopoly, and a monopolist is not going to be a price taker. But to maximize profit, the monopolist is still going to look at marginal revenue equal marginal cost. Any firm that wants to maximize profit is going to follow this rule. They will want to expand output until marginal revenue is just equal to marginal cost. And that will end up giving them the largest profit possible. So that tells us here how it is that a firm is going to want to maximize profit. To maximize profit, they're going to continue to operate. They're going to want to continue to produce until marginal revenue is equal to marginal cost. Now, this is economics class, so we're modeling. We're going to look at firms interacting in a market in the model of perfect competition in Chapter 9. But this is also an important rule to follow away in case you are ever working in business or ever starting your own business. You have to always look at marginal revenue and marginal cost to see if you're making yourself better off, to see if you're making a larger profit. Businesses sometimes will take on a small business, or a business might take on some extra business, an extra sales, an extra order, and agree to a price for that, and you're running a business, and then when you figure out, well, you didn't charge a price that was going to cover your marginal cost. And if you do stuff like that, you're going to find yourself working hard, running your business, and not making much of a profit. You're not making much of a profit because you're not following this rule. So this is a really important rule. If you end up working in business, or you're running your own business, what you need to do is focus on marginal revenue and marginal cost, and that's always true, regardless of what, whether a firm's a price taker or not, or if you're negotiating profit. It's like, say, if you're a contractor and you're negotiating a deal, or if you're running a lawn mowing company, you have to try and figure out how much you want to charge somebody to mow their lawn every week. You need to think about marginal revenue and marginal cost. You want to make sure that the marginal revenue is greater than marginal cost. Also, back in Chapter 1, we said that economics emphasizes the importance of marginal decision making, and this is another example, and it's perhaps the primary example that you have to look at the margin. There's a saying that says in economics, the action is on the margin. You always have to look at marginal revenue, things like marginal revenue and marginal cost. earlier when we were looking at consumers, we looked at marginal utility. Marginal utility was really important. So the action is on the margin, is marginal revenue, marginal cost that a firm was going to want to look at to maximize profit. Not, the total revenue and total cost are important too, but the thing that allows you to really focus in and identify when you've maximized profit is this rule: marginal revenue equal to marginal cost. So that's how a firm is going to behave to maximize profit.